take up E812 with the requirement here. What conclusions can be drawn from each of the four variances shown in the trial balance? Now, the company adopted the standard cost system. Labor standards were set on the basis of time studies and prevailing wage rates. Material standards were determined from materials specifications and the prices then in effect. On June 30, the end of the current fiscal year, a partial trial balance revealed the following. We have the debit and the credit. So material price variance, it's a debit. Material quantity variance, a credit. Labor rate variance, credit. And labor efficiency standard variance, a credit. Standards set at the beginning of the year have remained unchanged. All inventories are priced at standard cost. So we have now the following conclusions to be drawn from the four variances. Material price variance, which is debit, meaning it's unfavorable. It indicates that materials were purchased at a price higher than standard. For materials quantity variance, it's a credit, meaning favorable. It indicates that fewer materials were used in making the product than called for by the standard. The labor rate variance again is a credit, still favorable. It indicates that the wage rate paid to production workers was less than called for by the standard. And labor efficiency variance, still a credit, thus favorable, indicates that less time was spent on production than was called for by the standard. In E813, using variance analysis and interpretation. Last year, Wrigley Corporation adopted standard cost system. Labor standards were set on the basis of time studies and prevailing wage rates. Material standards were determined from material specifications and the prices then in effect. On June 30, the end of the current fiscal year, a partial trial balance revealed the following. Now, a credit balance for material price variance, quantity variance, debit, labor rate variance, and labor efficiency variance. Both are debits. Standards set at the beginning of the year have remained unchanged. All inventories are priced at standard cost. What conclusions can be drawn from each of the four variances shown in Wrigley's trial balance? So for the conclusions, we have the material price variance credit, meaning the favorable variance indicates that materials were purchased at price below the standard. For material quantity variance, which is a credit, no, debit. Material quantity variance, it's unfavorable, indicating that more materials were used in making the product than called for by the standard. The labor rate variance is still a debit. The unfavorable variance indicates that the wage rate paid to production workers was more than called for by the standard, and the labor efficiency variance still a debit, unfavorable, indicating that more time was spent on production than was called for by the standard. Now we have E8-14 with the following requirements: 1 to 4. Prepare journal entries for the following. Number 1, the issuance of direct materials into production and the recording of the material variances. Prepare separate entries for each department. So we have now for the number 1 requirement, we debit to work in process mixing for 185,000. This is standard cost of direct materials for actual production in the mixing department. Then we debit to material quantity variance in the mixing for 2,000. It's unfavorable. It's given unfavorable, and we credit to material price variance in the mixing. It's favorable, and materials is credited for the actual cost of materials used in the mixing department. So we have the first entry. Second entry is to debit the work in process account in the blending department for 130,000. Then we have to debit the material price variance in the blending for unfavorable variance of 4,000, and debit material quantity variance in the blending for 2,000, still unfavorable, and credit to materials for the actual amount of direct materials used for 136,000. Now, for entry number 2, we debit to work in process mixing for the standard cost of direct labor for actual production. Then we have to debit labor efficiency variance in the mixing for the amount of 3,000, and credit labor efficiency variance in the mixing for 10,000. Actually, we have 10,000 as favorable labor rate variance, though the labor efficiency variance of 3,000 is unfavorable. So we credit to payroll for 103,000. Credit to payroll for 103,000. Now that's for entry number 2. Okay, now we are still on IDAS 14. Question number 3. The entries record the actual and applied factory overhead. So in here in the blending department, we are still in entry number 2 to record the labor cost and the variances in the blending department. So debit work in process at standard cost for 95,000. Debit to labor rate variance unfavorable, the amount of 8,000. Labor efficiency variance still for 7,000 unfavorable, and we credit to payroll for 110,000. Then the next entry for number 3 is the entries to record the actual and the applied overhead. Now for debit in entry, debit to factory overhead for the various actual factory overhead costs. So we credit to various accounts. Then we have to debit work in process mixing for 85,000, work in process blending for 70,000, and credit to applied factory overhead. Then the last is the entries to transfer the production cost from mixing to blending and from blending to finished goods. So we now debit to work in process blending for 380,000, and credit to work in process mixing. Now we have the sum of 380,000 as 185,000 and 110 plus 85, composed of materials, labor, and factory overhead. Then we have to credit to work in process mixing. Second, we debit to finished goods and credit to work in process blending. So now we have the sum of 380,000 130,000, 95,000, and 70,000 for the cost from the blending department to the finished goods. Okay, we go now to a 8-15, still exercise, calculating factory overhead. The standard capacity of a factory is 8,000 units per month. Cost and production data follow. Standard application rate for fixed overhead, standard application rate for variable overhead, production month 1 and production month 2, actual factory overhead month 1, actual factory overhead month 2. So we have now the requirement, calculate the amount of factory overhead allowed for the actual volume of production each month and the variance between budgeted and actual overhead for each month. So for problem 15, we now determine the factory overhead allowed standard of 8,000 units. Then month 1, 7,400 units. Month 2, 8,200 units. The fixed overhead remains at the same regardless of the production in units. Then we have now your variable overhead. The variable overhead is 1.50 per unit. So 150 per unit. Number of units produced in column 1 is 8,000 units. So we now get 12,000. Here we have 7,400 units and 8,200 units. So 7,400, and then we multiply it by 150, we get 11,100 for factory overhead. And for 8,200 units, we have total factory overhead of 12,300. Now, based on 50 per unit times the 8,000 standard units at all levels. So you have now your month 1 and month 2. In month 1, given is the budget. In month 1, we had the actual overhead in month 1, 15,100. The budget was at 15,100 in month 2. We have the actual of 17,200 as given, and we have now the budget equal to 16,300 as computed above. Here we have the budget of 15,100. So the variance is 904 here, 17,200 and 16,300. We have the variance between the actual and the budget. The variance is unfavorable in month 2. Okay, the variance is unfavorable in month 2. Okay, so we now go to E816. What are the requirements in E816? Here in E816, the requirements are based on this information, determine the amount of the budgeted overhead for the actual level of production. The overhead application rate is $10 per unit, made up of $6 per unit of fixed overhead and 4 per unit of variable overhead. Normal capacity is 10,000 units. In 1 month, there was a favorable flexible budget variance of 2,500. Actual overhead for the month was 110,000 and actual units produced were 13,125. So we have to determine the amount of the budgeted overhead for the actual level of production. So we have the budgeted fixed overhead at 6 per unit. So we have now 10,000 units. That's at normal capacity. And the budgeted variable overhead is 4 per unit at the actual production of 13,125. So the budgeted overhead for actual production is 112,500, or actual overhead for the month of 110,000. We add the favorable flexible budget variance of 2,500. So the actual overhead of 110,000. We have now the budgeted overhead for actual production. We go to year 17. E817 now is requiring for the flexible budget variance, and B, calculate the production volume variance. C, was the total overhead over or under applied and by what amount. So first we have the actual overhead and the budget based on actual production and the standard hours times the standard rate. Now, requirements: A, calculate the flexible budget variance, and B, calculate the production volume variance. C, was total overhead over or under applied. So in letter A and B, we have now the actual overhead, the fixed cost of 52,000 factory overhead incurred, meaning the actual factory overhead, the variable of 28,500, so the total of 80,500. Now for the budget based on actual production, we have the fixed cost equal to 10,000 times 2 times 250. So we now have the fixed cost of 50,000. Then the variable cost, the actual production of 9,000 units, we multiply by 2 hours times 1.50 per direct labor hour. So we now get the total of 77,000. Then for the standard hours times standard rate, 9,000 units times 2 hours per unit, and we have $4 per hour. Now this data would end up with a determination of your standard hours times standard rate. So it gives us 9,000 times 2, 18,000 times 4 equals 72,000. So we have now the actual overhead of 80,500, and we have the flexible or the budget based on actual production of 77,000. We have the difference of 3,500. It's the flexible budget variance, which is unfavorable because the actual factory overhead exceeds the budget based on actual production. Then we are going to determine the production volume variance. It's 5,000 unfavorable. The budget based on actual production is 77,000, and standard hours times standard rate of 72,000. So the net factory overhead variance is 3,500 plus 5,000. Both are unfavorable. Now, So we have letters A and B. Then letter C was total factory overhead over or under applied and by what amount. So to determine the under applied factory overhead or the over applied, we compare the actual factory overhead, which is 80,500. We compare it with the applied factory overhead equal to the standard hours times the standard rate. So actual hours times standard rate of 18,000 hours times standard rate of 4. So you get 72,000. The applied factory overhead is 8,500. That's now under applied because the actual exceeds the applied. So meaning under applied or unfavorable. We now go to problem 18, calculating factory overhead to variances. The company normally produces 10,000 units of product A each month. Each unit requires 4 hours of direct labor. 4 hours of direct labor, and factory overhead is applied on a direct labor hour basis. Fixed costs and variable costs in factory overhead at the normal capacity are $10 and $5 per unit, respectively. Cost and production data for June follow. Production for the month 11,000 units. Direct labor hours used 42,000 hours. Factory overhead incurred for variable cost and fixed cost. Calculate the flexible budget variance and the production volume variance was total overhead applied or under applied. So the actual factory overhead given, the fixed cost of 103,000 and the variable cost of 48,000. So the total is 151,000. Now, the budget based on actual production, we have the actual production of 10,000 units. We multiply by 4 hours and multiply by the rate of 2.50. That's taken by dividing $10 by 4 hours. So 250 times 10,000 times 4 equals 100,000. The variable cost is here. We have the actual production of 11,000 units times 4 hours times 1.25 is taken by dividing 5 by 4 hours. So that's your variable rate. So the total budget based on actual production is 155,000, while the actual factory overhead is 151,000. So you have your flexible budget variance equal to 4,000, and it's favorable because the budget based on actual production is greater than the actual factory overhead. Then for the standard hours times standard hours is 11,000 times 4 hours per unit times 3.75. The sum of 250 and 125. So we now get 165,000. So we have 155,000. The difference of the production volume variance is 10,000. That's now your production volume variance, or which is favorable because the standard exceeds the budget based on actual production. So we have now the variances for the actual factory overhead 151,000. The applied is 165,000. So the over applied factory overhead is 14,000. That's the sum of 4,000 and 10,000. The sum of 4,000 and 10,000. So again, we have 14,000. Now for E17 and 18. Then we go to E8 19. E8 19 here for the requirements. What are the requirements of E8 19? For each month, make a single journal entry to charge overhead to work in process to close factory overhead into record variances. Indicate the types of variances and state whether each is favorable or unfavorable. You must first compute the flexible budget and production volume variances. The normal capacity of a manufacturing plant is 30,000 direct labor hours of 20,000 units per month. Standard fixed costs are $6,000 and variable costs are $12,000. Data for 2 months follow. So we have now the units produced in June and July, and we have the factory overhead incurred. For each month, make a single journal entry to charge overhead to work in process and to close it and to record variances. So the first entry we have on June 30. Now that's the end of the first month. Debit to work in process for the amount of 16,200. Then we have to credit factory overhead for the volume variance. It's unfavorable. We have a debit to factory overhead flexible budget variance for 500 and credit to factory overhead for 17,300. Now we have the given amount of factory overhead actual 17,300, and that's our credit to factory overhead. For the budgeted overhead for 18,000 units, being the actual production, you have the fixed overhead equal to 6,000, and for variable is equal to uh, 18,000 units times 0.60. So you get 10,800. Now we have the amount of 10,800 added to 6,000 or 16,800. So we have our flexible budget variance, the difference between 17,300 and 16,800. So we have the amount of the variance which is unfavorable equal to 500. Then for the standard hours times standard rate, we have now the standard hours equal to 27,000 hours. That's the standard hours. And it's computed by multiplying 18,000 units times we have 150 taken by dividing 30,000 direct labor hours by 20,000 units. So the standard rate is 150 multiplied by 18,000. So we get 27,000 units. That's your standard hours. Then standard rate is 0.60 for the standard hours times standard rate equal to 16,200. So the production volume variance is equal to 600, which is the difference between 16,800 and 16,200. Again, the variance is unfavorable. Now, how do we get the standard overhead cost per hour? The fixed overhead is given at 6,000 and the variable overhead of 12,000. The total is 18,000 and we divide it by 30,000 direct labor hours. We have 60 cents for the per unit. So we have now this standard variable overhead cost per unit is 12,000 divided by 20,000 units. So we now get 60 cents. Okay, 12,000 divided by 20,000 units. The standard variable overhead cost per unit is 60 cents, also as computed above. Now, July 31, the second month, we debit to work in process for 18,900. Okay. Debit to work in process for 18,900. Again, we debit factory overhead flexible budget variance in the amount of 2,200. Credit the production volume variance for 300 and credit back to factory overhead in the amount of 20,800. Now we have the analysis at the bottom. We have the flexible budget variance of 2,200 and we have 300 as the production volume variance. So credit to factory overhead at the actual cost of 20,800. Now we have the supporting computations for 21,000 units, the actual production multiplied by 1.50. So that gives us 31,500 hours that we consider as standard hours and multiplied by the standard rate of a 0.60. Okay, so we have now the requirements for E819 and we have E820, calculating the amount of factory overhead applied to work in process. So calculating the amount of factory overhead applied to work in process. The overhead application rate for a company is 2.50 per unit, made up of 1 peso for fixed and 150 for variable. Normal capacity is 10,000 units. In 1 month, there was an unfavorable flexible budget variance of 200. Actual overhead for the month was 27,000. What was the amount of budgeted overhead for the actual level of production? So the usual formula for calculating variances is shown below. Each step in developing the figures is numbered in order. So we have now the actual cost in number 20, the actual overhead for the month, 27,000. Then the budget for actual level is 26,800 and the amount of the flexible budget variance is given at 200, which is unfavorable. So that's the unfavorable flexible budget variance of 200. And it indicates that the actual cost was funded more than the budget for this level of production. Therefore, the budgeted cost was 26,800. That's the difference between 27,000 and 200. Note that you cannot use the budget formula to compute the budgeted overhead because the actual level of production is not given. Now we go to problem 21. Okay, for the exercises, we have problem 21. Now, using the four variance method, calculate the overhead variances. First, compute the budgeted fixed overhead rate. The Georgia Gasket Company budgets 8,000 direct labor hours for the year. The total overhead budget is expected to amount to $20,000. Standard cost for a unit of the company's product estimates the variable overhead as follows. So the variable overhead is 3 hours at $2 per direct labor hour. So the variable overhead is $6 per unit. The actual data for the period follow. Actual completed units 2,500. Actual direct labor hours 7,640. Actual variable overhead $16,100 and actual fixed is 3,920. So first we have to determine the budgeted fixed overhead. The total budgeted overhead is 20,000. It's given, and then we deduct the variable overhead for 8,000 hours at the rate of $2 per hour. So the variable overhead is 3 hours at 2 per direct labor hour. So we now get the variable component of 16,000 out of 20,000. Therefore, the budgeted fixed overhead is $4,000. For the variable overhead variances, the actual variable overhead is 16,100. And we now get the actual hours times standard variable rate. So the actual hours given at 7,640 times the standard variable rate of 2. So we have now 15,280. That's the actual hours times the standard variable rate. So we have now the difference of 16,100 minus 15,280, a difference of 820. Again, it's unfavorable because the actual variable overhead exceeds the actual hours times the standard variable rate. So meaning we have the variable spending variance, 820. Then we compute for the standard hours times standard variable rate, 2,500 units as given as the actual completed units. Then we have to multiply by the standard variable rate. That's equal to 3 hours times 2. So we have now the standard variable rate times 2,500, we get 15,000. And so the variable efficiency variance is 280. Actual hours times standard variable rate is greater than standard factory overhead. So the variable efficiency variance is 280. It's unfavorable. Then for the fixed overhead variances, the actual fix equal to 3,920. It's given. Then we have now the budgeted fixed overhead computed above at 4,000. So we have the variance of 80. That's the fixed spending variance. Then we now compute for standard hours times standard fixed rate, 2,500 units times 3 hours times 50 cents. So the budgeted fixed overhead here is 4,000 divided by 8,000 hours. So it's 50 cents. So we now get 3,750 and compare it with 4,000. The production volume variance is 250 and it is unfavorable. So we now get the net factory overhead variance. For variable spending, it's 820, unfavorable. Variable efficiency, 280, unfavorable. Fixed spending, 80, fixed, and 250, unfavorable. So we now get total of overhead variance, 1,270, and it's unfavorable. Okay, so we have now E21. Then we go to E822. E822, and here we are required to determine the following overhead uh, using the four variance method. Calculate the overhead variances. First, compute the budgeted fixed overhead rate. You have now the budget of 15,000 direct labor hours for the year. The total overhead budget is expected to amount to $42,000. Standard cost per unit of the company's product estimates the variable overhead as follows. The variable overhead is 3 hours times $2 per direct labor hour, so it's 6 per unit. The actual data for the period follow actual completed units, then actual direct labor hours, actual variable overhead, and the actual fixed overhead. So we now determine the total budgeted overhead of 42,000. We deduct the variable overhead of 15,000 hours times 2. That's the variable overhead rate. So the difference of $12,000, that's the budgeted fixed overhead. So for the variable overhead variances, the actual variable overhead is given at 33,000, and we now compare this with the actual hours times standard variable rate. So 15,500 hours among ang actual, and then you multiply this by the variable rate of 2. So the actual hours times standard variable rate of 2, we get 31,000, and the spending variance is 2,000. It's unfavorable because the actual exceeds the standard here. So we have the standard hours times standard variable rate. For standard hours is given, and then you multiply it by 3 hours. So we get total of 16,500 hours, and multiply it by 2. You get 33,000. That's your standard hours times standard variable rate. So the efficiency variance is 33,000 minus 31,000 is 2,000 favorable. Then we go to the fixed overhead variances. The actual fixed overhead is given at 11,700, and the budgeted fixed overhead is 12,000. That's the budgeted fixed overhead. It's given the budgeted fixed overhead because total overhead is 42, and then the variable is 30. The budgeted fixed is 12,000. Standard hours times standard fixed rate. 5,500 units times 3 hours times 0.80. That's the rate computed by dividing 12,000 fixed overhead by 15,000 hours. So we have now 80 cents per direct labor hour. So we now get the spending variance of 300 favorable. Production volume variance is 1,200 favorable. So the net factory overhead variance, unfavorable variable spending is 2,000. Efficiency 2,000. Fixed spending 300 and production volume variance of 1,200. So the net overhead variance is favorable by 1,500 because here we have 2,000 favorable, 300 favorable, 1,200 favorable. So 3,500 favorable minus 2,000. The net amount is 1,500. It's the net overhead variance, which is favorable. Then in E823, using the data given in E817, calculate the following overhead variances: spending, production volume, then efficiency, and was the overhead over or under applied. So we now go back to A817, fixed overhead of 52,000 and variable of 28,500. So the total is 80,500. For the budgeted overhead based on actual hours, we have 50,000 taken by multiplying 10,000 units by 2 times 250. Then the variable is 27,000 750. That's the budgeted overhead based on actual hours. So we now get the amount of here total 27,750 and compare with 8,500, you have a difference of 2,750. That's your spending variance. Okay, so we now get 18,500 times 150. That gives us 27,750. And the actual hours times standard rate, you get 18,500 times 4. And we have now 74,000. And standard hours times standard rate, 9,000 units times 2, 18,000 times 4 equals 72,000. So this spending variance to 750, production volume variance is 3,750 and efficiency variance of 2,000 unfavorable. So the net factory overhead variance is 8,500, all unfavorable. So we have an unfavorable amount. So in letter D, compute for the under-applied factory overhead. Actual factory overhead compared with the applied factory overhead. So we have the under-applied factory overhead equal to 8,500. That's in E823. Okay, so we stop for a while before I'll move on to the problems. Okay? Di makuha na lang na ma-converting.